Trump made a decision. The market dropped 5% in one day. He made another one. It recovered 7% the next morning, and most traders watching this had no idea what to do. Buy, sell, wait? Here's what's wild. This isn't really about Trump. It's about a set of mental traps that every human brain falls into. Traps that move markets, traps that drain trading accounts, and traps that even experienced traders don't recognize because they're invisible from the inside. I've studied how political decisions ripple through market psychology, and what I found will change how you see every trade you take. And the last bias I'll show you, most traders never even know it exists, but it's probably costing them the most. The setup. Why Trump plus markets equals a bias laboratory. Think about what happened when Trump announced sweeping tariffs in early 2025. Within hours, global markets tanked. Billions wiped. Traders panic sold. Headlines screamed recession. Then, a partial rollback. Markets bounced hard. The people who sold at the bottom, they locked in maximum loss. Now here's the real question. Was the sell-off logical, or was it emotional? The answer is both. And that's exactly what makes it dangerous. Because when logic and emotion mix in a trade, emotion almost always wins, and you don't even feel it happening. Trump's decisions, whether you agree with them or not, are unpredictable, loud, and emotionally charged. That makes markets around him the perfect environment to study how bias works in real time. So let's break down the exact biases his decisions trigger, and how they show up in your own trading. Bias number 1. Narrative bias. When Trump tweets something market-moving, what's the first thing traders do? They try to build a story around it. He's starting a trade war. This will crash oil. Tech is finished. This is called narrative bias, and it's one of the most expensive mental habits in trading. Here's the analogy. Imagine you're watching a thriller movie. 2 minutes in, you already think you know who the villain is. So for the next 90 minutes, every scene you interpret through that lens. You ignore the clues that don't fit. You only absorb the ones that confirm what you already believe. That's exactly what happens when traders build a story around a political event. They commit to a narrative, and then filter everything else to match it. Trump imposes tariffs. Dollar will weaken. Short dollar. Then price goes the other direction. They hold because the story still makes sense to them. Then they lose more. The market doesn't care about your story. It only cares about where the money is flowing. So instead of asking, why is this happening? Ask, where is price actually going? That shift alone can save you from a dozen bad trades per month. But narrative bias is just the beginning. Because once you build that story, another bias kicks in and locks it in place. Bias number 2, confirmation bias. You've already decided on the trade. You're long or short. You've got a position. Now what do? You go find evidence that you're right. You scroll Twitter, you watch YouTube, you read analysis. And weirdly, you keep finding people who agree with you. That's not luck. That's confirmation bias. Your brain literally filters out the information that challenges your position and amplifies everything that supports it. When Trump made his announcement about semiconductor restrictions, you had traders on both sides, completely confident they were right. Same news, opposite positions, both finding proof for their view. One of them lost money that day, and they still thought they were right. Here's what's at stake. Confirmation bias doesn't just make you hold losing trades longer, it makes you add to them. Because every piece of confirming information feels like encouragement. See, I was right, I should go bigger. That's how traders blow accounts. Not in one bad trade. In a series of logical decisions that were actually just one wrong story repeated multiple times. The fix? Before you look for reasons you're right, spend 60 seconds looking for reasons you could be wrong. It's uncomfortable, but it's what separates reactive traders from consistent ones. And speaking of reactive, the next bias is the most dangerous one in politically charged markets, because it operates on pure instinct. Bias number 3, recency bias. When markets crash after a Trump announcement, traders assume this will keep going down. When it bounces, traders assume this will keep going up. Whatever just happened feels like the new normal. That's recency bias. It's like driving a car while only looking at the last 10 feet of road behind you. The road ahead could be curving, but you'd never know. In early 2025, after a volatile tariff week, retail trader data showed a spike in short positions right as markets were forming a base. Those traders were reacting to the last few candles, not reading where price was structurally positioned. The result? They shorted the bottom. The market reversed. They got squeezed. Recency bias is especially deadly in news-driven markets because each new headline feels so significant that it overrides your technical view entirely. The antidote is zoom. When you feel certain, zoom out. Look at the weekly chart. Look at the monthly structure. Ask, am I reacting to this week or am I reading the actual market? Most times, the answer is reaction, and reaction costs money. Now we've covered how you interpret news, but there's one more bias, and this one isn't about reading the market. It's about reading yourself. Bias number 4, loss aversion, the one that costs the most. This is the one I mentioned at the start. Most traders have never named it, but they feel it every single day. Loss aversion is the reason you cut winning trades too early and hold losing trades too long. Here's the psychology. Your brain feels the pain of a loss approximately twice as strongly as the pleasure of an equal gain. Losing $5,000 hurts more than winning $5,000 feels good. That's not logical. That's biology. So what happens when markets move violently on Trump news? Your open trade is down $8,000. Pain kicks in, but you can't close it because closing it makes the loss real. So you hold. And it goes to $14,000 down. And now the pain of closing is even greater. So you hold more. That same week, you have a different trade. It's up $6,000. You feel relief. You close it fast because you're terrified of giving it back. End result? You let losers run and cut winners short. The exact opposite of every trading rule you know. And this happens not because you're a bad trader, it happens because you're human. The only structural fix is a system that removes the decision. Preset stop losses. Preset targets. Rules that execute before emotion has a chance to vote. Because when Trump tweets at 2 a.m. and your trade is live, your brain will not be rational. Your system has to be. So here's what we covered today. Narrative bias. You build a story and trade the story instead of the chart. Confirmation bias. You find evidence for what you already believe and ignore the rest. Recency bias. You treat the last move as the forever move. And loss aversion. The invisible force that makes you hold losers and kill winners. Trump's decisions didn't create these biases. They just put them on display, at scale, in real time. And here's the uncomfortable truth. None of this goes away just because you know about it. Awareness is step 1. The real work is building a process that operates independent of your emotions. Which brings me to something important, because knowing your biases is one thing, but there's a specific framework that profitable traders use to structure decisions so that bias has nowhere to enter. That's exactly what the next video is about. And if today's video clicked for you, that one will hit even harder.